So friends, we will be talking about a very interesting aspect nowadays which we are finding. The banks are facing ALM challenges because of deposit growth trailing behind credit growth, driven more by the demographic shift in the customer base. The new age Gen Z and millennial customers are increasingly choosing alternate investments sources instead of keeping their savings in the banks, creating new forms of risk for the banks. These structural shifts in the assets and liabilities are creating wider ALM gaps, and which is not a transitory phenomenon, that it is going to be rectified in the coming quarter or coming half year. It's not going to happen that way. So we will have to plan for the balance sheet management, taking a longer time span and longer vision, so that we are in a better position to align ALM with the deposit inflows and credit demands. And then the point is, as far as possible, every asset in the balance sheet should be scrutinized from the angle of risk adjusted return on an aggregate portfolio basis. Balance sheet and financial statements reflect the pulse of inherent profitability. I think we all of us know very well that each asset in the balance sheet is having a risk weight. So when the risk weight is more, it consumes more capital. So holistic balance sheet management has become very crucial, as each asset and liabilities has to be examined and kept in view, instead of keeping business parameters in view. Like normally what happens is, in a bank-like situation, target credit growth, we target RAM, that is retail, agriculture, MSME growth, and then we are also targeting deposit growth, CASA growth, and term deposit growth. All these things are very good. But how they are going to precipitate risk in the balance sheet, that also needs to be kept in mind, because balance sheet and financial statements reflect the pulse of it is going to reflect the pulse of profitability trends, and how the capital adequacy is to be maintained against those risk weights which are populating the balance sheet. So on one side, the business parameters, on the other side, how the balance sheet structure is going to change over a period of time, and what are the kinds of buffers that we need to maintain. If studied meticulously, then we will be able to make out the future shape of balance sheet. The balance sheet should therefore be read along with a wide range of qualitative information, because today's qualitative information is going to impact tomorrow's balance sheet items. Like, for example, the market share, product profile, customer grievances trends, compliance standards, digital efficiencies, preparedness to withstand cybersecurity attacks, and borrower and depositor profiles, changing banking patterns, cash withdrawal trends, and many other aspects. When we look at all these things, will build the balance sheet over a period of time. Today, if the market share is coming down, that means tomorrow the balance sheet size may come down, or may have items which will have higher risk weight. That is what one has to perceive. That is the reason why SEBI and RBI, they prescribe mandatory disclosures with the twin objective of alerting the regulated entities on one side and keeping the investor community informed on the other side. These disclosures will give information to the analysts about how a particular bank is going to perform in future, and the authenticity of the disclosure standards are verified by the regulator through the risk-based supervision, on-site inspection or off-site inspection. The regulator under a Basel II framework, that is the banks will be, RBI will be conducting the on-site and off-site inspections. The RBI also closely monitors the compliance culture to ensure that the risks remain within the stated risk appetite, because that's very important. If they are taking more risk, then it may jeopardize the longer interest of the organization. The task of building the size and quality of the balance sheet is, however, the prerogative of the lender, that is the bank. The bank can decide how much it wants to grow, at what rate it wants to grow, how it is going to choose its path of growth. All these things are the freedom given to the regulated entities. That is the reason why we find that in the same macroeconomic situation, business and regulatory environment, some regulated entities build strong balance sheets while others are not able to keep pace in that way. The reasons can include governance quality, ethical values, compliance standards, risk culture, leadership drive, and institutional capacity to harness the growth potentiality that is emerging in the market. More important, however, is that the risk should be read properly by the banks so that they can articulate the future shape of balance sheet along with risk weight and the total risk of the entity and how much of capital will be required for that kind of a shape of the balance sheet. So if you are projecting the business parameters for FY27, if you are doing it for quarter 2, quarter 3, quarter 4, you should also articulate your balance sheet for those periods along with the risk weights and the expected return or risk adjusted return on the balance sheet. Because if you don't have a total grip, then it becomes difficult. So we must have a strategic vision and find out solutions to the asset liability gaps that are emerging. A continuous shift in customer behavior calls for adjustment to the structure, size, and composition of the balance sheet. Beyond tactical performance, the bank should be able to target year after year the shape of the balance sheet and the shape of businesses that are business parameters that are going to emerge. That is why I have put the title Balance Sheet Vision 2030. It doesn't mean that 2030 is the final point. You can have 2035, you can have 2040, you can have the future shape of balance sheet. But the point that I want to highlight, along with deciding the targets of business parameters, very good, we can always do it because it is up to the regulated entity to carve out its own path of growth. But at the same time, it should also be able to make out what will be the shape of the balance sheet, what will be the risk weights of each item in the balance sheet, and what will be the risk adjusted return on that particular shape of balance sheet, so that so to test whether our NIM is protected or not, whether our gross NPAs are under control, whether our net of provision, whether NPAs are under control. These things have to be looked into. If you see the recent data points, it will be interesting to see the banking system's assets grew from 220 trillion in 22-23 to 330 trillion in 25-26, recording an annual growth rate of 12.8% in 2023 and it increased to 13.4% in 25-26. During the same period, deposits have increased from 214 trillion to 262.3 trillion, with growth rates of just 7.8% and 13.47%. Whereas the credit increased from 136 trillion in the same period to 214 trillion, giving a growth rate of 14.3% and 16.1%. That means the deposits have not been able to keep pace with the credit growth. They were trailing behind, as a result of which the ALM gaps have widened. It led to liquidity risk. Because the liquidity risk is high, banks had to borrow against from the liquidity adjustment facility of RBI LAF window, and also from they had to raise funds through CDs, that is certificate of deposits. They had to depend on the bulk deposits to see that they are in a position to manage their liquidity risk. So banks should build strong back office teams to manage the balance sheet. These teams should monitor each item in the balance sheet and its risk, study how and why actual levels differ from the estimated levels and determine what kind of interventions are needed to keep the balance sheet on expected lines. Balance sheet growth should be strategically developed with lighter risk weight, which should consume less capital and still remain focused on generating sound revenue. So prioritizing balance sheet management will strengthen integrated risk management system and can ring fence banks against undue ALM gaps and undue liquidity risks as we are now facing, and it will be able to streamline the development of various parameters of business. So we should focus totally on balance sheet management, keeping 3 or 4 years as our time span, and it should be on a rolling basis. Like if you are having a balance sheet of 2030, next year you should have a balance sheet span of 2031, following year 2032. So you should be in a position to know the shape of your balance sheet 4 years from now, 5 years from now, what will be the parameters of performance in terms of deposit growth and credit growth and all various other parameters that are very critical for the banking system. So let's focus on balance sheet management, and I think we will be able to mitigate the ALM gaps and try to reduce the kind of risks to which we are currently exposed. So we will be talking more about these kind of issues in the coming times. Till then, I would request you to give a feedback as to what kind of topics you are interested, so that we can build some kind of inputs on those kinds. And please do subscribe if you haven't subscribed this channel, and share these inputs with your friends and associates. With the very purpose of having this YouTube channel is to disseminate knowledge. Thank you very much for watching.